gain. And so, that's kind of the capital transition strategies. That's kind of where the 1031 exchange falls under. So just in a real basic sense, the government provides the opportunity for investment real estate owners, keyword investment real estate owners, not your primary residence, doesn't qualify. So investment real estate owners can sell their property. And then if they follow the guidelines, which are pretty well laid out, you have 45 days from the day you sell your property to identify what they call replacement property, and then 180 days to buy a new property. If you follow the rules, the government won't tax you on that transaction. And, it all kind of comes back to, well, why do these tax codes exist? Well, there's either incentives for environmental and socially responsible behavior, or this kind of falls under the business continuity where, if your business was real estate or you're trying to transact and you want to dispose of a property and buy into a new property that you find more compelling, why should the government come in and take 30-40% of your money away in taxes because this is an ongoing business proposition that you're doing? And so
is that like a rhetorical question? Oh, sorry.
Yes, they often try to take the taxes as often as they can. So anyway, this is for investment real estate owners who want to sell their property. If they do it correctly, they can buy another property and pay zero taxes.
All right. So guys, that's the basic. This is for when your people come to you, they've made a killing on an investment property and they want to take that money and sell it, use the equity to buy more real estate to hopefully produce more. That's what it is. So Jason, we decided on a Q&A format. So what property types are eligible for a 1031 exchange?
Yeah, so Lisa, notice I emphasized investment real estate. Now, people often get confused with the terminology like-kind exchange as well. Like-kind exchange does not mean that you're selling a duplex or multifamily and you have to buy a duplex or multifamily. That's not what like-kind exchange means. Like-kind means that you're going from an investment real estate property to an investment real estate property. So it could be going from a multifamily to self-storage. You could trade into any other type, as long as the end of the day, your motive is it's investment real estate. It's not for your personal use.
All right, I like that. So it can really be anything. It could be a car wash, a residential house, a multifamily, a co-op, whatever, as long as it was determined that it was an investment property, then it qualifies. So there's no property type issue. You mentioned 45 days to identify a property and then 180 days, and I apologize, I didn't catch the terminology, 180 days to
close the transaction.
Okay, so I would think for me, like it could take longer to identify a property. Do you know what I mean? Like I would think that, like if I'm waiting 120 days, that means my client is delivering his documents by pigeon. Okay, so why such a huge discrepancy between the time to identify and the time you get to close the transaction? Is it because mainly people have done this with large commercial transactions?
Yeah, so that's part of it. Really, it's and this is where a selfish plug for Todd and I, where some of our products come in, because oftentimes they might have identified commercial real estate and it doesn't work out, or it takes a prolonged period of time to close on it. So 45 days to identify, that goes pretty quick. The clock starts ticking the day the transaction closes. So you have 45 days to make a list of the properties you want to identify as replacement properties, and there's rules for that. But 180 days to complete the transaction, the paperwork, fund the payment, and a lot of times those fall through. So that's where some of Todd and my programs come in.
Okay, so what I'm hearing in terms of my head means you got a contract for the sale on your investment property, you delay that close to give you more time to find a property to turn that, like, to make this work, you gotta, that 180 days on the back end serves you on the sale. Right? So that you're not really closing on that sale, which would then give you 45 days. That makes sense?
So a little bit different, Lisa. So the identification rules, there's three different types of ways you can quantify your identification. The easiest is you identify 3 properties. That's the first method. The second one is you can identify up to 200% of the value of the properties you're replacing. So there's different rules. We don't need to focus on that.
Yeah, okay.
But you can't, if you didn't identify it within the first 45 days, you can't change it. And, you know, if it's not on your identification list, it's not going to happen. So
Got
the
it.
first 45 days and even before that, and, you know, to all you folks out there just talking with real estate owners, we want to get engaged before the sale. And that's
Before the
critical
sale.
on many different reasons. You know, I'm sure Todd's run into this, I've run into this, and, you know, I'm talking to a client who says, we want to do a 1031 exchange. Well, great. When's your closing? Oh, it was last Friday. It's like, all right, so game over.
Yeah,
You're
actually,
doing a 1031
Shelley,
exchange.
I think this answers the question. Shelley put a question in the chat that said 1031 can't be done retroactively. It has to be set up before the initial sale of the property, right?
Right, so it's imperative and critical you engage what's called a qualified intermediary, a QI for short. A QI's entire role is to set up an escrow account, and they also document the 45 days, and they formally list the properties that you've identified. These are all functional things that the IRS can come to you and say, I want to see what you identified, and if you closed on something different, it's not allowed. But, you know, it's a formal process, and the QI, one of the biggest things they do is set up an escrow account so that the seller does not have constructive receipt, meaning they took it, it hit their bank account, done. You know, it's got to go to an escrow account so they don't have constructive receipt.
So one of the things that I think we touched on a little yesterday is, you know, we're in a world of Airbnb and VRBO. And a lot of people have purchased what they identified as second homes to their mortgage lenders, but they're renting it. Okay, there's rental income. They occupy it 2 weeks out of the year. I mean, how do you differentiate that when that goes to a sale? You know, is there something that would disqualify that property from a 1031 exchange? Or does it automatically, because there's rental income on it, we've qualified the rental income and they're not spending more than 2 weeks a year there, does that qualify for a rental property? To me, this is fascinating. And I think this is an issue that the mortgage industry is going to face going forward when we're identifying second homes. But I want to know, how does it apply in the world of a 1031 tax exchange?
Yeah, so it's great question, Lisa. It's pretty cut and dry. And the number is 14. So if you've used the place personally 14 days or more, it's considered, you know, not a vacation or not a investment property because of your personal use. So you need to use it for less than 14 days. And you also need to show that you've actually rented it. And they will look at that. So you need to document, you know, the fact that it's been rented out, and they don't want you just to buy it and go use it yourself. Yeah.
Yeah. In the mortgage world, they have to use it for 14 days for it to be a second home, which is really interesting. So, okay. So a lot of times we are, you know, hopefully on the front end of this, where a client's coming to us and saying, I want to sell my investment property. What's the first thing that we should tell our clients to do?
Let's talk to a qualified intermediary. If you haven't already talked to a qualified intermediary, let's engage one because that's step one. And it's not a complicated deal. They're professionals, many of them attorneys. And what they're going to do is put a contract in place with the client, and they just add a few sentences to the closing contract that states the intention of the client is to do a 1031. And here's the other thing, it's not all or nothing. And so your client could sell a property for $1 million and decide they want to do a 1031 with 500,000 and take the other 500, and they'll just pay the taxes on that amount. So they are just putting language in the contract that says your intention is to do it with some of the assets and then line up the escrow account to receive the proceeds.
Wow. So you mentioned the qualified intermediary. Who are the other players in the 1031 exchange?
Well, depending on what the intention is, Todd and I work quite a bit in a transaction. So, you know, what Todd and I do when it relates to 1031 exchange is we provide a securitized version of the replacement asset, where many people are looking for, you know, a triple net property or another property to invest in. Todd and I work with professionally managed properties where they can become passive investors and shed their management responsibilities. The other thing that we do very importantly, as it relates to what you guys might come across, is if someone's selling a property for like $2 million, and the rule is, in order for it to be tax deferred, you need to acquire an equal or greater value property. And so it's hard to match up, you know, 2 million and find one exactly the same price. So if they find one for 1.7 million, Todd and I can help you with the remainder equity, and because the programs we work with have 100,000, maybe even 50,000 minimums. So we can bridge the gap of the shortfall between the two transactions and make it a completely deferred transaction.
Nice. Nice. I like that. I like that. Okay. So, I think we touched on this. The only other question was like, you know, how long can the fund sit in an account waiting for the next property? And basically, the 45 days is the identification period, but it could sit up to 180 days, right? Technically waiting for that new property to close.
Right. Usually if you're in it for 180 days, there's a lot of there's a lot of negative implications if you haven't closed, you know, you're waiting for the 170th day, odds are you're about to pay a tax. So,
yeah,
you know,
it's
important in advance, you know, to talk to your investment real estate owners, to educate them in advance of even them thinking about the transaction. Let them know there's different opportunities. There's different ways for them to become passive investors if they want to retire and they're looking to cash out. You know, I'm sure you guys come across a lot of instances where it's a really labor intensive business to run these properties. So
right.
A lot of times they don't know that there's properties that Todd and I work with that allow them to become passive. So they just look at, you know, if I sell, I'm going to end up paying a tax. So you could do a really good service for them, just letting them know that there's a way to become passive and still do a 1031 exchange.
I like that. I like that a lot. So Jonathan wants to know, does the intermediary or the IRS look at the mortgage application?
No, not that I'm aware of. The intermediary, they're not really involved on the loan side of it. So the intermediary really is taking the equity position. At the closing, if there's a bank debt on the property, the closing attorney for the seller is going to send one check to the bank to pay off the debt, one check to the escrow account to put the equity aside. And that's really what the QI is working with, the equity. And so when they go to acquire the property, they might be working with you guys on the acquisition side, but it's more the owner of the property that's going to be lining up the financing.
So Emily, I struggle with this too a little bit. So we're going back to that word identify in that 45-day period. So I heard you say you recommend sometimes that they identify more than one property so that there isn't really a fallout, you know, if one property doesn't come through. And so that doesn't mean those properties that they're looking at are under contract. It means they've identified that these are the properties that they might want to buy with a 1031 tax exchange. And then that back end of 180 days gives them the time to get it into contract, get the transaction closed, et cetera, et cetera. Is that, am I understanding that correctly?
You are, Lisa. I mean, I could identify the building you're in, doesn't mean I'm gonna buy it.
Right,
You know?
okay,
So you're identifying, you could identify anything on the last day of the 45 days. And this is where, you know, Todd and I kind of throw the securitized transaction, the fractional ownership in there as a fallback, because how many times have you guys seen a real estate transaction not go through? So if you are putting
Never.
unrealistic expectations of what your listing has identified and they don't come through, you can't list more after the 45 days. So you want to list stuff that's realistic.
Guys, this is a great educational tool to take to your real estate agents, especially this piece of it, you know, of the opportunity to identify for an investor to buy more, and Kevin, I'm gonna hang on one second, we'll ask that, for an investor to buy more than one property. The identification of multiple properties so that if a deal does fall through, they don't lose that whole benefit of the 1031 tax exchange. Okay, I love this, you guys. Kevin's asking if a REIT's able to do a 1031, and you might have to break that down a little bit for everybody.
Great question, because a lot of people think real estate's real estate. A real estate investment trust is a big portfolio of diversified real estate typically, and it doesn't qualify. But I'm not going to go into this. There are DSTs that offer, and DST, sorry, short for Delaware Statutory Trust. This is the securitized transactions that I was mentioning Todd and I focus on. They offer the ability to go into the DST and then you're in it for 2 years, and then they have their own REIT. Usually it's a multi-billion-dollar real estate diversified portfolio, and they'll absorb the DST. They'll give you the option to roll your DST into the REIT. So it's kind of a two-step process to get into there, and it provides a lot of diversification, but you can't directly go into a REIT.
Okay, so you get that, Kevin? I think you want to be in the DST first and then roll that into the REIT. Ken Franti's asking, with respects to the proceeds, okay, do you need to use all the funds towards a new purchase, which I think you addressed it. You can use partial funds, but I like the second piece of his question, which is, can you take out the initial investment from the property you're selling? So if you spoke about this, like if you sell a property for $1 million, you only want to take 500 and invest in a new property. What if your initial investment was 500? You're not going to pay taxes again on that initial investment, right? You're only paying taxes on what is considered a gain.
Yeah, so, you know, this is why it's really important for investment real estate owners to have a trusted accountant or CPA or enrolled agent they work with.
Yes, it is.
If you're, particularly if you're skipping from property to property, you have to track your cost basis all along the way. You have to track, you know, the expenses that you put into it that changes your cost basis. So you really need to figure out what your capital gain exposure is. And if you don't have a capital gain, there's not a lot of point to do a 1031 because it's going to limit your options. You know, and on the other side of that, 1031 is not the only solution. I'm not going to go into it today, but there are qualified opportunity zone funds. You guys may have heard of opportunity zones being in the real estate industry, and it qualifies for any type of capital gain to roll into it, and it has some different benefits, typically a little bit higher growth assets. So if they're not able to find something in you know, investment real estate quick enough, there's other options too, that they can actually go beyond the 45-day identification period and still be able to defer.
So guys, for me to take as a takeaway, and I'll Kim, remind me, because we're going to do this in the follow-up. For me as a takeaway, here's what I would be teaching my real estate agents that concentrate on investors. Number one, figure out whether or not they're going to take a big capital gain hit on an investment property they're selling. If that's the case, teach the realtor how to suggest also to get a qualified individual in the center there. All right, that's number, or get them to us. Frankly, we can save them that capital gain by putting them in the 1031 tax exchange. So we teach them what it is, how it benefits their customer, and the fact that they're gonna wanna identify more than one property for that seller, for that buyer, person to buy as part of this process. And guys, I can tell you that even those real estate agents that do 1031 tax exchange, they're missing that last little piece. From what Jason said, that's a big piece. Okay, that's a big piece that could cost them a ton, 15% of the gain on their property right now today. So this is a great opportunity to be able to go back to your agents and teach them this and make yourself their partner in this, so that they can take those investors, you know, that they have that want to flip properties and buy new ones. Guys, this has been, thank you, both of you. I know Todd's been the quiet guy today. So, but like, guys, this is really great information. And it gives us tremendous value to take to both our real estate partners and our clients who are investors. So guys, anybody else have, we got about 5 minutes left. Anybody have any questions on this?
I do.
Go ahead, Shannon.
Really, Jason, I'm in Illinois, so I missed the first 2 seconds of your speech, but how would I find a qualified, would I search?
Intermediary.
Yes.
Intermediary.
Would I search attorneys? Would I search CPAs? How do I find one of those?
Shannon, I'd be happy to recommend trusted ones that we've worked with over and over. So we have a handful that I just kind of go back to because they're just really reliable. So I'm happy to share that with you.
In Illinois?
And you can lean on Todd and myself anytime, guys. You can call us and ask us any question you want. We're here.
And
to
you guys,
answer
we're gonna put all your follow-up information so you're national, right? You're
We are.
national?
Mhm.
Yeah, so Shannon, yes, absolutely. And guys, I'm gonna say this, you want a recommendation, because this is not the thing for somebody's 80-year-old real estate attorney to take on. If they are not someone who has done this before, it could be, and especially even some CPAs have an issue with it.
Again, Lisa, if I could just
Yeah.
add one thing, you were mentioning the tax. It's actually a lot more than the 15. It's probably typically going to be a 20% capital gain. Plus they're paying state tax, which is probably, California up to 12, 13%.
Right.
Plus, if you've depreciated every year, which everybody does, and you sell for a profit, you're recapturing all that at a flat 25% tax rate. And so it ends up being closer to 35, 40%. So it's a major hit for these folks.
Wow. That's, guys, I totally take this back to, because it's not just real estate agents. This is something we should educate our attorneys on. Kevin threw something in the chat, and he's worried that with homes going so quickly, what happens if all the properties that are identified are sold before they can do this? All those properties, like you said, all those 3 properties fall through. So I know you guys mentioned that you had a vehicle that is more of a passive investment management, that those funds could then be moved into, that then would also skip the tax, correct?
Right. And great question, because deals fall through all the time. And so you want to have both realistic identifications, but fallback options also in case those close out. And that's where Todd and I come in. Our programs can be identified, the day of, because we've got an inventory of 35 properties on any given day. And so you write us down as part of the identification, and not use the 3 property rule. The second rule, I'm not going to go into it, but allows you to identify a lot more properties. And so you could put a few DSTs down just in case. Hopefully your property doesn't fall through, but just in case, we're there for backup.
I like that. Kevin, I hope that answers your question. All right, guys, any final questions here? You guys get something out of this today? Because I did. I know I got a ton. This was great information. about something that literally made me just, every time my client said it, I'm like, oh no. But now since I met Jason and Todd, I'm like, oh, now I know what to do these. I'm like, hey guys, we got this. We got this. And the key is, this is yet another thing to talk to your clients who have been investing for a lot of years. And this is an opportunity for them to save some money while they're investing in new properties. Guys, you guys want any final words? You got like, I don't even know how many people, so almost 40 people on the call today, and I know you've brought us a lot of value, so I really appreciate that.
Yeah, so thanks so much for having us, Lisa. Everybody, we appreciate your time today. Let us help you. You know, it is complicated. There's a lot of moving parts. There's a lot of details. We're happy to just help out as an educational vehicle. And, you know, our side of the programs, we come in and, you know, if your clients are looking to retire and shed those management responsibilities, we could help out quite a bit in a lot of different scenarios.
We love that. We love that, you guys. And I think my hope is that we're going to have some opportunity for you as well. I definitely think that's the case. So guys, all right, listen, Cindy Gordon says great info. Thank you guys so much. Thanks, you know, both of you for jumping on this morning, and you know, we'll see you again soon. All right. All right, guys, listen, everybody have a great
Thanks so
day.
much.
All right.
Thank you.
Bye, guys.
Take care.
Bye.